January 19th, 2026. While markets slept, a policy document surfaced in Washington, buried in defense appropriations, $2.5 billion, strategic minerals, silver at the top of the list. But here's what they're not telling you. The COMEX vaults. 120 million ounces registered. January alone. 41 million. Gone? Do the math. 120 divided by 41. 2.9 months. April. The largest online dealer just sent a confidential memo. Significant mint failure. Production capacity cut in half. Shanghai trading at a $12 premium. JP Morgan stopping 98.5% of all deliveries. When the vault hits zero, there's a legal clause. 3 words that will change everything. Force majeure. What happens when the US government enters a market that's already running on fumes? Welcome to Currency Analyzer. You know, if you've been watching financial markets as long as some of us have, perhaps since the days when silver certificates were still in circulation, you understand that certain moments require attention. This is one of those moments. We don't sensationalize, we analyze. Now, if you value this kind of strategic economic briefing, the kind of information that institutions pay thousands for, and you'd like to ensure you don't miss critical updates in the coming weeks, may I suggest you click that subscribe button below? Think of it as securing your seat at a table where serious economic discussions happen. And please, leave a comment telling us where you're watching from today. Are you in North America, Europe, Asia, perhaps the Middle East? Your perspective matters because what we're about to discuss affects every corner of the global economy. Now then, let's proceed with part 1. On the morning of January 19th, 2026, a document began circulating through the defense procurement offices in Washington. Most analysts skimmed past it. Another appropriations bill, another budget allocation. Routine paperwork in a city built on paperwork. But 3 policy specialists noticed something unusual, buried in Section 1047. Subsection D, a single line authorization, $2.5 billion, designated for critical mineral acquisition, specifically targeting the strategic national stockpile. And at the very top of the mineral list, silver. This represented something extraordinary. For the first time in over 3 decades, the United States government was reversing a policy that had defined its approach to commodities since the end of the Cold War. The government was no longer selling, it was buying. To understand why this matters, one must look back. Throughout the 1990s and early 2000s, Washington operated under a simple philosophy. The world had entered an era of globalization. Supply chains stretched across oceans. Just-in-time delivery systems replaced the need for strategic reserves. Why stockpile silver when you could simply purchase it on the open market whenever needed? Between 1995 and 2005, the government liquidated approximately 150 million ounces of silver from the national stockpile. They sold it, melted it down, dispersed it into industrial channels. The logic seemed sound at the time. Markets were efficient, suppliers were reliable, peace dividends allowed for lean inventory management. But that world, the world of frictionless global trade, began showing cracks in 2020. Supply chains fractured during the pandemic. Then came the semiconductor shortage. Then the rare earth mineral crisis. Each disruption revealed the same uncomfortable truth. Critical materials, the ones that determine whether missiles fly or satellites function, cannot be purchased with unlimited flexibility, physical availability. It turns out, matters more than purchasing power. By late 2025, defense analysts began submitting classified assessments to Congress. The assessments were blunt. The United States imports approximately 6,400 tons of silver annually. Roughly 45% comes from Mexico, where mining operations face increasing labor disruptions and cartel interference. Another 25% originates in Peru, where political instability creates supply uncertainty. Chile, Canada, various smaller sources, all subject to forces beyond American control. Meanwhile, silver's role in defense systems had only expanded. Modern missile guidance systems require silver conductors. Military-grade radar uses silver-coated components. Satellite communication arrays depend on silver's unique reflective properties. Electronic warfare systems, drone technology, next-generation fighter jets, all consume silver in quantities that would have seemed absurd 20 years ago. Then there was the green energy equation. The current administration had committed to aggressive decarbonization targets. Solar panel deployment rates needed to triple by 2030. Each solar panel contains approximately 20 grams of silver. The math was simple and terrifying. Meeting renewable energy goals would require roughly 150 million ounces of silver per year, just for the United States alone. Add military requirements, add industrial demand, add consumer electronics. The total exceeded 200 million ounces annually. But here was the problem. Global mine production, the actual metal coming out of the ground, totaled approximately 830 million ounces per year. China alone consumed nearly 200 million ounces. India took another 150 million. Europe, Japan, South Korea, the rest of Asia. By the time the accounting finished, there was barely enough to meet existing demand, let alone increased government purchasing. The Pentagon analysts understood this. They ran the scenarios. In a conflict situation, in a trade war, in any circumstance where normal supply channels closed, the United States would be functionally silver-starved within 90 days. No silver meant degraded weapon systems. No silver meant stalled renewable energy projects. No silver meant technological vulnerability at the exact moment when technological superiority determined survival. So the policy shifted. The $2.5 billion authorization was not simply a purchase program. It was an acknowledgement. An acknowledgement that the era of market reliance had ended. An acknowledgement that strategic autonomy required physical reserves. An acknowledgement that some resources were too critical to leave to the invisible hand of supply and demand. But the authorization came with a unique characteristic. Unlike private buyers, unlike hedge funds or industrial consumers, the government program operated under mandate. There was no price ceiling. There was no budget constraint that would halt purchasing if silver reached $100 or $150 or $200 per ounce. The directive was clear. Acquire the metal, secure the supply. Cost was secondary to availability. And this mandate, this single policy decision, was about to collide with a market that was already fracturing. Because while Washington was drafting appropriations language, while analysts were calculating national security requirements, the physical silver market, the actual vaults where real metal sits, was quietly, systematically, running empty. 3 traders sat in a Chicago trading floor conference room on Friday afternoon, January 17th, 2026. The screen in front of them displayed a single number, 345. 345 delivery notices, issued in a single day, in January. One of them leaned back in his chair. "That's impossible," he said quietly. But the CME Group's official delivery report, the one published at 4 p.m. Eastern, confirmed it. January was supposed to be silent. In the commodities futures world, months are categorized. Delivery months and non-delivery months, March, May, July, September, December. These are the big ones, the months when contracts expire and physical metal changes hands. January. January was a transition period, a quiet interlude between December's conclusion and March's beginning. Historical data told a consistent story. January 2023, 287 contracts stood for delivery, roughly 1.4 million ounces. January 2024, 412 contracts, approximately 2 million ounces. January 2025, 520 contracts, about 2.6 million ounces. A gradual increase, predictable, manageable. But January 2026, 888 contracts, 41.44 million ounces. Not a gradual increase, an explosion. Something had fundamentally changed in the market's behavior. The delivery report revealed more than just the total volume. It showed who was taking delivery and who was providing it. Friday's single-day data told a remarkable story. Of the 345 delivery notices issued, JP Morgan's house account stopped 340 of them. 98.5%. One institution, absorbing nearly every available ounce that crossed the delivery threshold. This was not normal market behavior. This was accumulation. Systematic, aggressive, intentional accumulation. On the other side of these transactions, Bank of America, they had issued 275 of the 345 notices. In simple terms, Bank of America was desperately trying to deliver silver, and JP Morgan was taking everything they offered. This dynamic, when analyzed carefully, revealed a critical market structure problem. Someone was short, someone was caught, someone needed to deliver metal they did not have, and someone else, someone with deeper pockets and better positioning, was exploiting that vulnerability. But the more important question was not who was winning this institutional battle. The more important question was, where was all this silver coming from? The answer lay in a specific category on the COMEX inventory reports. Registered versus eligible. Total COMEX silver inventory appeared substantial, over 300 million ounces. But that number was misleading. The 300 million included eligible silver, metal stored in COMEX-approved warehouses, but not available for delivery against futures contracts. This metal belonged to private owners, institutions, entities who simply used COMEX facilities for storage. It could not be touched, could not be delivered, could not satisfy contract obligations. The only category that mattered was registered silver, metal that was warranted, verified, and explicitly available for delivery. As of January 17th, 2026, the registered category contained approximately 120 million ounces. That sounded like a large number. Until one performed a simple calculation. January had consumed 41.44 million ounces. 120 million divided by 41 million, 2.92. Less than 3 months. If the current consumption rate continued, the registered category would reach zero by early April. But the current consumption rate was not going to slow down. It was going to accelerate. Because of what was happening 6,800 miles away in Shanghai, the Shanghai Gold Exchange, China's primary precious metals trading platform, was experiencing its own crisis. The price of silver on the Shanghai Exchange had decoupled from the COMEX price. COMEX, the Western benchmark, showed silver trading at $93 per ounce. Shanghai, the Eastern benchmark, showed silver trading at $105.03, a $12.70 spread. In commodity markets, such spreads should not exist for more than a few hours. Arbitrage traders exist specifically to exploit these differences. Buy in the cheap market, sell in the expensive market, pocket the difference. The spread should collapse almost immediately. But it was not collapsing. It was widening. This told sophisticated observers something critical. The spread was not caused by temporary inefficiency. It was caused by physical unavailability. There was not enough silver in the West to arbitrage over to the East. The metal simply did not exist in sufficient quantities to close the gap. Chinese industrial consumers, particularly the solar panel manufacturers who produce 80% of global solar capacity, were bidding desperately for metal. And the Chinese government, recognizing the panic, had attempted intervention. On January 12th, the Shanghai Gold Exchange issued emergency restrictions, position limits, previously set at 7,000 contracts per trader, that were slashed to 3,000 contracts. The intention was clear. Stop the hoarding, slow the buying, calm the market. In normal circumstances, such regulatory intervention would crash prices. Traders would flee, demand would evaporate, equilibrium would return. But when the Shanghai Exchange announced the restrictions, the price jumped. It went from $102 to $105.73 in 3 trading sessions. The restrictions had the opposite effect, because industrial buyers interpreted the government's panic correctly. If authorities were trying to ration silver through position limits, it meant silver was genuinely scarce. The regulation confirmed the shortage rather than alleviating it. So the manufacturers doubled down. They bought more aggressively within their reduced position limits. They coordinated purchases across multiple entities. They did whatever was necessary to secure supply. And this created a feedback loop that was draining the Western markets. Every ounce of newly mined silver, every bar coming out of a Swiss refinery, every delivery leaving a London vault, faced a simple economic choice. Ship to New York and sell for $93, or ship to Shanghai and sell for $105.73. The metal flowed east, relentlessly, predictably, unstoppably. This was why J.P. Morgan was stopping 340 contracts in a single day. They were building a dam, trying to prevent the remaining COMEX silver from bleeding out to Shanghai, trying to corner what little metal remained in the Western system, because they understood what was coming in March. March, the primary delivery month, the month when the truly large contracts expired. Current open interest for the March contract suggested potential demand exceeding 300 million ounces. But by March 1st, if January and February continued at the current pace, the registered inventory would stand at approximately 80 million ounces. Maybe less. 80 million available, 300 million demanded. The mathematics did not work. The vault could not deliver what it did not contain, and that was before the $2.5 billion government program even began writing checks. Ken Lewis had been in the precious metals business for 23 years. He had seen crashes, rallies, panics, manias. He had navigated the 2008 financial crisis, the 2011 silver spike to $49, the 2020 pandemic buying surge. But on Saturday morning, January 18th, 2026, he sat at his desk and wrote an email he had never imagined writing. The subject line read, "Critical Operations Update. Immediate action required." Ken Lewis was the CEO of APMEX, the largest online bullion dealer in the United States. His company moved hundreds of millions of dollars in precious metals annually. They had warehouses, contracts with major mints, relationships with refineries worldwide. If anyone had access to silver, it was APMEX. But the email Ken Lewis was writing, the one being sent to the company's highest volume clients, told a different story. "We are currently experiencing demand levels approximately 4 times our normal volume," the memo began. 4 times normal. That would be impressive for a business, except for one problem. The next paragraph. Due to a significant development at our private mint operations, our production capacity has been reduced by approximately 50% effective immediately. Demand up 400%, supply down 50%. The mathematics of that equation led to only one conclusion: shortage, severe, immediate, and worsening. But what Ken Lewis called a significant development required deeper examination. APMEX, like most major dealers, did not rely solely on government mints. The U.S. Mint produced Silver Eagles, yes, but those came with high premiums and limited availability. To serve the mass market, APMEX had developed their own product line. APMEX branded bars, APMEX branded rounds, generic silver products that carried lower premiums and higher profit margins. Approximately 90% of their bar and round sales came from these proprietary products, and all of them were produced at private mints, facilities that took raw silver grain and struck it into retail-ready forms. But the private mints required feedstock. They needed raw silver, refined to 999 purity, in granular form that could be melted and cast. And that feedstock, historically sourced from refineries and industrial suppliers, had simply stopped arriving. Phone calls to suppliers in Switzerland went unreturned. Orders placed with Canadian refineries were delayed indefinitely. Mexican sources, normally reliable, reported force majeure at their smelting operations. The global supply chain that fed the retail silver market, the chain that turned mined ore into coins people could hold, was breaking. Not slowly, not gradually, breaking completely. One mint manager in Ohio explained it simply during a call with APMEX procurement. We have the capacity, we have the equipment, we have the workers, but we don't have the silver. Where did it go? The APMEX buyer asked. If I had to guess, the mint manager said, it's on a plane to Shanghai, or it's sitting in a JP Morgan vault, but it's not coming to us. This was the downstream effect of everything happening at the institutional level. When JP Morgan stopped 340 delivery contracts in a single day, when the arbitrage spread to Shanghai hit $12.73, when the Chinese government tried to ration trading through position limits, the consequences did not stay contained in futures markets or sovereign vaults. They cascaded down to the retail level, to the small dealers, the coin shops, the online platforms where ordinary investors actually bought physical metal. APMEX understood they were facing an existential crisis. They had orders, thousands of orders, people ready to buy, but they could not fulfill those orders without metal, and they could not get metal without feedstock. And feedstock was not available at any price. So they made a decision. On Saturday afternoon, the website was updated, a new policy, effective immediately. Minimum order requirement, $500, no exceptions. If someone wanted to buy a single Silver Eagle, $35, they could not. If someone wanted to buy 5 generic rounds, $150, they could not. The buy button would not activate unless the cart total exceeded $500. This was rationing, not through price, though premiums were rising, but through access. The small investor, the person who saved $50 per week to buy an ounce or two, was locked out. The door had closed. Only those with significant capital could enter. One customer service representative, fielding angry calls on Monday morning, tried to explain it. Sir, I understand your frustration, but we are prioritizing bulk orders because we have limited inventory and we can't waste shipping costs on small purchases. What she did not say, what she could not say, was the darker truth. APMEX was triaging. They were deciding who got metal and who did not. And in that decision, the retail investor, the small buyer, the ordinary person trying to protect savings, was deemed expendable. The company's survival required focusing on high-volume clients, institutions, wealth managers, family offices, buyers who purchased in $50,000 or $100,000 increments. Those relationships were worth preserving. The individual buying $100 per month was not across the country. Other dealers were making similar calculations. Local coin shops, the small businesses that had served communities for decades, were going dark. One shop owner in Texas posted a sign on his door Tuesday morning. Closed until further notice. No inventory available. Will reopen when supply returns. Another dealer in Florida updated his website. Currently not accepting new orders. Existing orders delayed 6 to 8 weeks. Thank you for your patience. A shop in Pennsylvania simply stopped answering the phone. The retail distribution network, the system that connected ordinary buyers to physical silver, was collapsing in real time, and the collapse was accelerating because of human psychology. When people heard they could not buy something, they wanted to buy it more. The $500 minimum did not discourage buyers. It triggered panic. People who had been casually interested in silver, who had been waiting for a dip, suddenly realized the dip was irrelevant. Price did not matter if the buy button was grayed out. Availability mattered. So they scrambled. They called friends, pooled money, borrowed from family members, anything to reach the $500 threshold, anything to get in before the door closed completely. One Reddit forum dedicated to silver investing saw posts multiply. Is anyone else having trouble finding metal? My local dealer is out of stock. Where can I buy? APMEX just canceled my order. Said no inventory. What's happening? The panic was spreading, and every panicked buyer, every person rushing to secure metal, only made the problem worse. Because they were not buying from a replenishing supply. They were buying from a fixed, shrinking, nearly exhausted inventory. Each purchase brought the system closer to zero. And zero, in the silver market, was not just a number. Zero was the point where the legal protections embedded in futures contracts activated. Zero was the point where exchanges could invoke clauses most investors had never read. Zero was the point where paper promises, carefully written contracts, legally binding agreements, could be dissolved with 3 words: force majeure, act of God, circumstances beyond our control. And that point, according to the mathematics, was less than 90 days away. There's a clause buried in every COMEX futures contract. Most traders never read it. Most investors assume it will never apply to them. It sits on page 47 of the standard agreement, section 12.3, subsection B. The language is precise, deliberately vague, legally bulletproof. In the event that delivery of the underlying commodity becomes impossible or impracticable due to circumstances beyond the exchange, is reasonable control, including but not limited to acts of God, government action, war, civil unrest, or material supply disruption. The exchange reserves the right to settle outstanding contracts through cash payment at a price determined by the exchange. Force majeure, French legal terminology meaning superior force. In plain English, it means the contract can be broken. It means the promise to deliver physical metal can be replaced with a check. And that check, that cash settlement, is calculated at the paper price, not the real price, not the price you would actually pay to secure physical metal on the street. The paper price, the number on the screen, the fiction. For decades, this clause remained theoretical, a legal safeguard that existed in the fine print but never activated. Because the COMEX always had metal, the vaults were deep, the supply was adequate, delivery was routine. But January 2026 had changed the equation. 41.44 million ounces, gone in a non-delivery month. 120 million ounces remaining in the registered category. And the calendar, the merciless calendar, was moving toward March. 3 financial analysts working for a European pension fund ran the numbers on January 20th. Their model was simple. Take the current registered inventory, 120 million ounces. Subtract the projected February drain, conservatively estimated at 35 million ounces. That left 85 million ounces entering March. Then look at the open interest for March contracts. As of January 17th, open interest stood at approximately 180,000 contracts. Each contract represented 5,000 ounces. If even 20% of those contracts stood for delivery, a historically normal percentage, that would be 36,000 contracts. 180 million ounces demanded, but only 85 million available. The math did not work. One of the analysts, a veteran who had tracked commodity markets for 15 years, stared at the spreadsheet. "This isn't a squeeze," he said quietly. "This is structural failure." His colleague nodded. "What happens when they can't deliver?" "Force majeure," the first analyst replied. "They'll cash everyone out." "At what price?" "Whatever the paper market says, probably $95, maybe $100. "And the real price?" Silence. Because that was the question no one could answer with certainty. When the COMEX declares force majeure, when physical delivery becomes impossible, the paper price and the physical price divorce completely. They become 2 separate markets. The paper market, where contracts trade based on technical analysis and momentum, and the physical market, where actual bars change hands based on desperation and availability. History provided hints about how wide that gap could become. In March 2022, the London Metal Exchange faced a similar crisis with nickel. A short squeeze drove the price from $30,000 per ton to $100,000 per ton in hours. The exchange responded by canceling trades, suspending the market, and forcing cash settlements. Traders who had been right, who had positioned correctly, were simply erased from the ledger. The exchange chose institutional survival over contract integrity. In the silver market, the dynamics were different, but the principle was identical. When the vault hits zero, when delivery becomes impossible, the exchange protects itself. Not the contract holder, not the investor who followed the rules. The institution and the U.S. government's $2.5 billion purchase program accelerated this timeline dramatically. because government buying operated under different rules. When Apple needed silver for iPhones, they were price sensitive. If silver hit 120, Apple would redesign products, find substitutes, reduce usage. When Tesla needed silver for solar panels, they negotiated, hedged, managed exposure. But when the Department of Defense needed silver for missile guidance systems, price was irrelevant. There was no substitute for silver in certain military applications. The physics did not allow alternatives, so the mandate was absolute. Acquire the metal, cost secondary to availability. This created a terrifying scenario for anyone holding paper silver. Imagine a trader who bought futures at $93, expecting to take delivery in March. He did everything correctly. He held through volatility, he maintained margin, he prepared for delivery. March arrives, he stands for delivery, and the exchange sends him a letter. Due to unprecedented supply constraints and force majeure conditions, your contract will be settled in cash at $95 per ounce, the determined settlement price. $95. But when he tries to buy physical silver to replace what he was promised, dealers are quoting $180 dollars. If they have inventory at all, most are simply closed, sold out, unavailable. He received $95 for something worth $180. Legally, he has no recourse. The contract explicitly allowed cash settlement under force majeure. He signed it, he agreed, he is bound. This was not theoretical speculation. This was the logical endpoint of the current trajectory. And sophisticated players understood it. This was why JP Morgan was stopping 340 contracts in a single day. They were not buying silver because they loved the metal. They were buying silver because they understood the end game. When force majeure hits, when the vault empties, physical holders win, paper holders get destroyed. JP Morgan intended to be on the winning side. Bank of America, desperately issuing 275 delivery notices on a single Friday, was on the losing side. They were short, they were trapped. They were trying to deliver metal they did not have, and every day the situation worsened. Because the government program had not even begun official purchasing yet, the $2.5 billion authorization was approved. But the actual procurement process, the contracts, the delivery orders, those would roll out through February and March, when government buyers entered the market with blank checks, when they began competing directly with JP Morgan, with Apple, with industrial users. The remaining inventory would vanish in days, not months. One derivatives strategist at a major bank sent an internal memo on January 21st. The memo was classified, meant only for senior management, but a copy leaked to a precious metals forum by Tuesday evening. The key paragraph read, "Our models indicate a 73% probability of COMEX force majeure declaration by April 15th, 2026, with physical paper price divergence potentially exceeding 100% within 48 hours of announcement. Recommend immediate reduction of paper long positions and acquisition of physical metal where feasible. Clients holding futures contracts should be advised of settlement risk." 73% probability. This was not a fringe analyst making sensational predictions. This was a major financial institution's derivatives desk, warning their own clients, get out of paper, get into physical, before the trap closes. But here was the cruel irony. The very warning, when it leaked, would accelerate the crisis it described. Because when investors learned about force majeure risk, they would try to take delivery early. They would stand for delivery in February instead of March. They would rush the vault, and rushing the vault would drain it faster, would bring the force majeure event closer, would ensure the very outcome everyone feared. This was the doom loop, the self-fulfilling prophecy. The prisoner's dilemma, where rational individual action created collective catastrophe. April 2026. That was the mathematical deadline. The point where registered inventory, current burn rate, and government buying converged. Some analysts thought it might extend to May. Optimists suggested June, but no one credible believed the current system could survive past summer. The question was not if force majeure would happen. The question was who would be holding physical metal when it did, and who would be holding worthless paper. Meanwhile, across the Pacific, Chinese industrial buyers were asking the same questions. They saw the COMEX data. They understood the timeline. They knew their factories required 15 million ounces per month just to maintain current solar panel production. If Western markets locked up, if exports stopped, if supply chains froze, Chinese manufacturing would face immediate crisis. So they were not waiting. They were buying everything available at any price. This was why Shanghai was trading at $105.73, while New York traded at $93. This was why the arbitrage gap refused to close. This was why Chinese regulators had desperately tried to slow buying through position limits, but position limits could not overcome physical reality. The metal was running out, globally, simultaneously, irreversibly. And when it finally ran out completely, when the last ounce left the last vault, when the delivery notices exceeded available supply by an impossible margin, the exchanges would make their choice: protect the institution, declare force majeure, cash out the paper holders, and leave physical metal in the hands of those who had secured it early. April, less than 90 days away. The clock was not just ticking, it was screaming